Hello and assalamu alaikum everyone. So today we're going to talk about the starting of the new chapter, that is 5.2 sources of finance. But before start discussing about the sources of finance and short-term and long-term sources differences, we are first going to talk about what are the difficulties that businesses face when they are trying to raise finance. That is basically what problems do new businesses face when they experience when trying to raise finance. So in this particular lecture we're going to talk about the basic, particularly about new business problems in raising finance. So, without further ado, let's begin. Now, for new businesses, it is often very difficult to raise large amounts of finance if you're in this business. So, there are a couple of reasons for that, of course. So, first of all, being the lack of financial history. Therefore, lack of evidence that the business will be able to repay any finance loan. So, if they don't even, if the bank, the lenders don't see the financial history of business, how can they lend a business? Okay, if the business is established and after some time they show their financial record to the lend to those to the lenders, then perhaps they will be able to get some loans. But if they don't have a financial record history, then it becomes difficult for banks or lenders to just hand them over the loans, because they don't have the evidence that will they be able to repay it back to us or not. Then there comes the lack of experience of the owner, which may lead to lack of confidence in the financial management of the business. Now, this is not too much big, one of the major problems that there is, but it is some of those problems that I've just listed down all the problems that is. So, it is one of the problems, however, not the most major one, because usually owners do have confidence, but if they don't have confidence, if they lack confidence, then that means the financial management of the business will also lack confidence. Like, if the owner is inexperienced, then they can't handle the business properly, the new business properly. So the financial management could not be controlled properly, and because of that, the financial management can't properly ask for loans, or the financial management, the lack of confidence is the major issue because of which they can't actually ask for good loans or convince banks. So that's the whole idea behind this point. But when we say the financial management, of course, if it's a new business, then someone might say, well, they don't have enough employees. Well, that's true. When we say financial management, that does not mean that there should be a whole management department. It could also mean the owner himself could be the part of financial management if it's like a sole trader business or just a new startup. Basically, startups don't have a particular legal structure. All legal structures have different startups, but we're talking in general for financial management. Financial management could include owner or partners themselves, or when we say about private limited company, then there could be some family members or friends. Public limited companies could be anywhere, anyone else. So yeah. Now, lack of security, or as you can say in business terms, collateral, to offer any potential lender. This can lead to higher rates of interest being charged due to perceived risk to the lender. That is, you can't have secured loans. When you ask for businesses for potential lenders, you can't just have, because of your lack of security, that is, you don't have enough collateral, you don't have enough assets to give to the business in exchange for secured loans. You can instead have unsecured loans, which have a higher risk, because of which they also have a higher rate of interest. So that's why it's not easy to have an secured loans and unsecured loans. Even if you are able to convince your bank somehow to get unsecured loans, then they have higher rates of interest attached to it, which may be costly to the business in the long run. Now, bank overdrafts can often be negotiated, but usually at higher rates of interest. So similar to the unsecured loans, but their rate of interest is usually higher, but the amount that bank overdrafts offer is also much high. So, but overall, this will impact on the cost of the business, similar to unsecured loans. There could be credit purchases, like when you are a new business might try to arrange to buy its goods on credit, but suppliers might be reluctant to do this. So a business will want to do that, but the suppliers will of course be reluctant to do this because of the lack of credit history and knowledge of the business. So if the new business is selling goods on credit and has to wait for its customers to pay before its suppliers, this could add significant delay to the payment of suppliers. This might mean that suppliers will not extend credit to business until it is more established. So this is a long back point, perhaps. So some of you might be having trouble understanding this. Basic idea behind this is that new business will want to pay pay the for suppliers at a later time on credit. Okay, you used your suppliers now, but okay, I will pay the cost of suppliers to you, price of suppliers to the suppliers after I have received payments from the customers. But that would mean that customers usually want some extra credit time. So let's say you have sold your product to customer, but they will give you money at 30 days later, and 10 days ago you just ordered your suppliers. So that will overall mean you will be paying your suppliers after 40 days, and that's a huge time for suppliers, and they might just not extend credit at all. So they won't extend credit until they know, okay, the business is a trustworthy business, it is an established business, okay, it can return a payment properly. So yeah, only then they can do that. But for new businesses, of course, that's not the case. They can't do that. So yeah, that's a problem when you're trying to raise finance. That your credit purchases it becomes a problem. You can't purchase on credit. Family and friends might offer financial support, but this is unlikely to be likely to be limited, and might cause some interference in the business from those friends and family. So of course, friends and family can't offer too much amount. The finances, of course, are supposed to be limited, but even with that limited finance, they will be, similar to shareholders, interfere in your business decision making, and they might say, okay, I message on your business, I also have some authority over you, I also my decision should also be considered, or something like that. So that becomes a problem as well. So overall, problems can be reduced by producing a realistic and well thought out business plan. Okay. Sorry, just a mistake over here. Let me correct that. So this was about yeah. So that's about the problems. That if all these problems could be reduced by producing a realistic and well thought out business plan. So if you have a good plan, okay, suppliers might trust you. They might offer you credit. You might be able to get loans from banks with a lower rate of interest, or you can have some your financial management will also be confident in getting some thinking of some other ways to raise finance, such as having microfinance, or convincing venture capitalists to invest in the business, or perhaps even be able to set up crowdfunding. So that could also be done if your financial management is also confident. So these are all the problems that are there, and how it could be solved. We just said that the financial management could be, if we had a good, well thought out business plan, then your financial management will also be strong, and you will be able to think of some other ways of securing finance, or you can just have this good business plan to have credit purchases to convince your suppliers to pay at a later date, or you can just have loans, etc. So moving on, we have reasons why banks might also not provide loans. So we just discussed that, okay, there are a lot of problems with raising finance, but we haven't discussed much about the banks. We just said that, okay, they might just not offer it because of the lack of trade credit history, and if they do, they will just be unsecured loans which have high rate of interest. But now let's have one more detail about the reasons. So the bank may be unconvinced of the ability of business to pay back a loan. That's similar to the last point somewhat. The borrowings of a business may be seen as being too high. So if you borrow too high of amount in starting a business or starting machinery, perhaps you want to start up directly with a capital intensive business, then the cost of purchasing machinery is too high. So banks might be reluctant to provide that high borrowing. Or the business may have submitted inferior business plans. We just said that in order to reduce all these problems, you need a well thought out business plan. So if you don't have a well thought out business plan, your plan is inferior and it's just not enough to convince those banks, then they won't offer you loans. Banks may also be unconvinced about the marketing plans or quality of management of the business plan. So similar to inferior business plan, they might also not be convinced about the marketing plans. Okay, they're not convinced that you will be able to repay them back. They might think, okay, your marketing plans are not too much efficient. You won't be able to survive that much long in the market, and you won't be able to pay back my debt. and the bank may be concerned with inadequate cash flow and collateral. So if the business of course don't have any collateral, so the bank will be convinced about that there's a risk attached to it, and they might also you know if they don't have collateral, then that means they will have to give them unsecured loans, which has a high rate of interest, but it is high riskier as well because of the inadequate cash flow. They might not sure about the cash flow. If the business will have a good cash flow that they can give their money back as soon as possible or not, will the business be able to repay back the debts? So that's also a concern for banks. And finally, this is just an external factor that the state of the economy and the liquidity of the bank means that the bank may be unwilling to lend money to many businesses, including an entrepreneur. So despite okay you have a good business plan, your borrowings are not too much, you are able the bank is convinced that okay this person will be able to give back my loan, but still banks may not provide you loans because of these external factors, that the state of economy might not be too well, economy might be going to recession, or the bank itself has its liquidity going down, it might be becoming illiquid, because of which it won't be willing to lend any money. So that's the problem with the external environment, not with the internal environment. So we discussed about the problems of new businesses and the banks as well. So that's all for today. Thanks for watching. In the coming lectures, we're going to talk about the different sources of finance, as well as the difference between short-term and long-term sources of finance. Thanks for watching. Allah Hafiz.